Earning less than the market for years while paying more for the privilege is what happens when you ignore how index funds work. You chase star managers, pick theme funds you saw in an ad, and swap funds after a hot streak. You are handing over higher fees and trading costs, you are taking on extra taxes, and you are accepting results that trail the simple market return you could have had. You sit at your kitchen table moving money between funds that felt exciting last season, while the quiet market tracker you skipped keeps pulling ahead, and you do not see the gap until much later. Here's the basic idea. An index fund is a basket designed to match a market yardstick. It does not try to be clever. It buys the same companies in the same proportions as the yardstick and then gets out of the way. When the market changes, the basket updates automatically because the yardstick updates, not because a manager made a guess. This structure matters because it removes the need for constant decisions. No manager is waking up thinking about which stock to dump or which hunch to chase. The fund simply mirrors the market's list and waits. That means less trading, fewer mistakes, and far fewer ways for human judgment to trip over itself. The market's average becomes your baseline instead of a moving target set by a person with a story to sell. Cost is the first reason experts default to index funds. Expenses on broad index funds often sit around 0.1% per year. That is the toll to rent the market's return. When that toll is tiny, you keep almost everything the market gives you. Costs compound the same way returns do, so cutting them is not optional if you want a fair shot at the average. Turnover is the second reason. Because index funds are not guessing, they trade less. Less trading means fewer realized capital gains in taxable accounts and lower friction inside retirement plans. You're not paying for a research team to pitch ideas that have to be unwound later. The machine is simple, and simple machines break less often. Active funds usually cost more because you are paying for selection, marketing, and the burden of constant trades. Many of them charge around 1% every year. That fee shows up whether the manager beats the market or not. Over time, that drag takes a slice of your compounding and hands it to the fund company. You do not see the bill line by line, but it is there in your ending balance. The most common beginner mistake with this topic is thinking selection skill always exists and that you can find it in a list of star ratings. People sort by last year's performance, buy whatever popped, and then hold it just long enough to catch the next slump. The result is buying high and selling low in slow motion. By defaulting to a market tracker, you step out of that game. The index does what it does, and you stop being your own worst enemy. Let me show you how this plays out in real life. A nurse sets her workplace plan to buy a broad market index fund and never touches it again. Her friend in the same hospital picks a hot sector fund after a magazine cover and bounces from theme to theme as the news cycle changes. Years later, the nurse has a portfolio that mirrors the market with minimal fuss, while her friend owns a patchwork of stories that never added up. The gap did not come from genius. It came from removing decisions that did not need to exist. Another trap is mistaking narrow focus for sophistication. A fund tied to a tiny slice of the economy looks exciting when that slice is in the headlines, but it ignores most of the companies that actually drive the broad market. Concentrated bets swing wildly, and the timing has to be perfect to land the gains and avoid the pain. That timing rarely shows up when you need it because you only know the full story after it is too late to act. The correction is boring on purpose. Start with a broad stock market index as your core, then layer in other pieces only if you have a clear reason. What does that mistake cost in practical terms? It costs stability you could have had for free. It forces you into trades you never planned, which rack up taxes if you are outside a retirement account. It also pushes you into cash after a slide because the volatility feels personal, and now you miss the early recovery that never announces itself. You did extra work to earn less money and more hassle. Here's the clean way to do it. Pick a broad domestic stock index fund for your growth engine. Pair it with a plain bond index fund to set your risk level to something you can live with through a rough year. Automate contributions from your paycheck so there is nothing to remember. Then rebalance about once a year by directing new money to the lagging piece rather than selling what did well. If you invest through a workplace plan, look for a target date option that is actually built from index funds under the hood. The label should tell you whether it tracks broad indexes and what it holds. If the only options are complicated or expensive, choose the broadest and cheapest fund available, even if the menu is not perfect. In an individual retirement account or a brokerage account, you can be more precise. Search for funds that track the total stock market, the total international stock market, and a simple bond index. Read the summary page, not the glossy marketing language. Not every index fund is the same. Some track a narrow list that excludes major parts of the market. Some claim a smart set of rules but charge far more for it, which defeats the point. What you want is transparent, low cost, and tied to a well-known benchmark with a long history of being hard to beat. If the methodology reads like a riddle, you can skip it. Tax efficiency is another quiet advantage. Exchange-traded versions of index funds have a mechanism that reduces capital gains distributions in many cases, which helps in taxable accounts. That difference matters less inside retirement accounts where gains are deferred, so choose based on convenience there. The point is not to chase a vehicle just for tax trivia. The point is to avoid paying a tax you did not need to pay because a manager churned your holdings. Understand the risk you're actually taking. Owning the whole market does not spare you from downturns. It exposes you to the same ride everyone gets. The advantage is that you are not layering manager mistakes or narrow bets on top of that ride. Your risk is market risk, which is the only risk you get paid to take over long stretches. To handle that, set a stock and bond mix that you can hold through a grim season without flinching. Time does the heavy lifting here. Over 20 years, the difference between a strategy that hugs the market and a strategy that constantly guesses turns into a visible gap, even if both look similar during a few lucky seasons. Compounding does not care about headlines. It cares about how much you kept after fees, taxes, and bad trades. Index funds quietly stack those small edges because they remove the leak points. If you are tempted by a manager with a great story, remember the incentives. Funds with strong recent numbers get promoted, while the weak ones disappear from the shelf, which leaves you with a biased picture. Very few managers continue to beat the market after costs once the clock runs. The ones who do are nearly impossible to identify in advance without hindsight. Experts know this, which is why they default to the machine that does not rely on identifying rare talent. Implementation should be dull and repeatable. Open the account that matches your tax situation, pick the broad index funds that fit your plan, and set the transfer to happen on a schedule. Ignore market forecasts. Ignore ranking lists that change with every season. Focus on the two levers you control: costs and behavior. Do not hold index funds you cannot explain in a sentence. If you need a brochure to say what the fund tracks, it is the wrong choice. Do not add new funds just to feel busy. Busyness is not a strategy. It is how you turn a simple plan into a complicated toy that breaks when life gets loud. Keep the number of moving parts low so that mistakes have nowhere to hide. Revisit your allocation when your life changes, not when the news cycle changes. A new job, a new family member, or a new goal can justify adjusting your mix. Headlines cannot. The market does not know you own it, so it does not owe you a feeling of safety. Your discipline has to cover the parts your emotions want to hijack. The single shift this lesson asks for is to stop treating investing like a talent contest and start treating it like a systems choice. Own the market at low cost, remove decision points you do not need, and let time finish the job. Next, we will take this mindset into renting versus buying and do the real math so you know how your housing choice fits the plan.